questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. Before we begin, I would like to mention that some of the statements made in today's discussion may be forward-looking in nature and may involve risks and uncertainties. Please note the disclaimer mentioning these risks and uncertainties are on the disclaimer slide of the investor presentation that has been shared earlier. I will now hand the conference over to Mr. Imtiyazur Rahman for his opening remarks. Thank you. Over to you, sir.
Thank you, Dobin. Good evening, everyone. Thank you for joining us today to discuss our operational and financial performance for the second quarter and the first half in the 30th September 2023. It is my privilege to welcome you all. You might have gone through our press release and investor presentation available on our website as well as on the website of the stock exchanges. The world economy is yet to reach the pre-pandemic level of growth and is witnessing inflationary pressure. But this has paved way for emerging markets like India to have a prominent contribution towards the global economic growth. The economic scenario in India is optimistic, continuing the momentum of last couple of quarters. For the current fiscal, IMF has raised the GDP growth forecast to 6.3% for India. Friends, during the quarter, there was another milestone achievement for the Indian capital market. JP Morgan announced inclusion of Indian sovereign bonds into its emerging market index. According to industry experts, this inclusion is likely to result into inflows of around $30 billion in investment into Indian debt market, which have traditionally been held primarily by banks and financial institutions. Inclusion of Indian bonds with effect from this next fiscal with maximum weightage of 10% is a testimony of India's emerging significance in the global financial market. Coming to the equity market, the Indian indices have well captured this optimism, as is evident from the new all-time high touched by both benchmark indices during the quarter. This has also led to an increased participation in the Indian mutual fund industry. I am happy to share with you that the September 22, 2023 data from AMFI reveals that the industry now has 40 million unique mutual fund investors in India. Coming to UTI, I am happy to share with you that on 29th September 2023, we successfully inaugurated 29 new offices across the country, taking the total number of UTI financial centers to 195. We continue to be committed to growing our presence in the beyond 30 locations and make mutual funds more accessible to the people in the Tier 2 and Tier 3 cities in India. Friends, 134 of our UFCs are now present in these locations, staying committed to guide more and more people about mutual funds. UTI conducted 82 investor awareness programs pan-India, covering 4,600 participants in the first half of financial year 23-24. While the geographical reach has increased, we are also working on our digital strategy and reach. We relaunched our mobile app for our investors and distribution partners with a better user interface, and have also adopted a state-of-the-art technology for our contact centers. On the HR front, we have now new CFO, Mr. Vinay Lakotia, who is the career UTIan and is also handling the corporate strategy function of UTI AMC. We have also elevated Mr. Anurag Mittal to be the head of fixed income of UTI Mutual Fund. Now sharing numbers for UTI Group, the total assets under management for UTI Group registered a growth of about 17% over the corresponding quarter of the previous year and it stood at 16.9 lakh crore as on 30th September 2023. The domestic mutual fund business witnessed a growth of 14.22% year-on-year with a quarterly average AUM as on 30th September 2023 at 2.67 lakh crore. We launched 4 successful NFOs during the first half of this fiscal. UTI Nifty Equal Weighted Index Fund, UTI S&P BSE Housing Index Fund, UTI Balance Advantage Fund, and UTI Innovation Fund during this half year. Now, I hand over to Mr. Sandeep Samsi, Head Marketing and Investor Relations, who will update all of you with UTI AMC performance in a greater detail. Over to you, Sandeep, and thank you.
Thank you, sir. I will first take you through UTI Mutual Fund performance during the second quarter and the half year ended September 30, 2023. UTI Mutual Fund performance for this period. UTI was able to capture a market share of 7.8% of the gross sales of the industry during this quarter. Our equity quarterly average AUM for the quarter ended September 2023 stood at rupees 78,291 crores, rising by approximately 9.2% as compared to the quarter ended September 2022. With passive investment gaining traction, we have witnessed a growth of about 35.82% in the quarterly average AUM for index and ETFs, taking it to rupees 98,421 crores for the second quarter. ETF and index fund net flows stood at rupees 2,364 crores. UTI added 1.03 lakh folios, taking the number of live folios to 1.22 crores as on September 30th, 2023. Our SIP AUM witnessed a growth of 29% over the corresponding quarter of last year, reaching to rupees 26,541 crores as of September 2023 from rupees 20,565 crores as of September 2022. The SIP inflows for the quarter stood at rupees 1,648 crores. The SIP gross inflows for UTI Mutual Fund witnessed a year-on-year growth of 1.11% with an average ticket size being rupees 3,140 rupees for September 2023. Coming to the contribution from B30 cities, 23% of our monthly average AUM for September 23 came from B30 cities, while the industry average stood at 17% in terms of its B30 monthly average AUM. Coming to UTI AMC's financials, during the second quarter, the company posted a consolidated net profit of rupees 183 crores. The consolidated revenue from operations for the second quarter stood at rupees 404 crores. For the first half, the consolidated net profit was rupees 417 crores, higher by 43% year-on-year. The consolidated revenue from operations for the first half stood at rupees 872 crores, up by 27% year-on-year. On a standalone basis, the PAT of UTI AMC Limited for Q2FY24 is rupees 134 crores, reflecting a growth of 14% on a year-on-year basis. The PAT of UTI AMC Limited for the first half of FY24 is rupees 299 crores, higher by 38% year-on-year. We are happy to inform that our 100% subsidiary, UTI Retirement Solutions Limited, has recorded a growth of 24% year-on-year in its AUM, reaching to rupees 2.7 lakh crores in Q2 FY24 and currently it manages 26.4% of the NPS AUM. The PAT of UTI Retirement Solutions for the first half of FY24 is rupees 25.2 crores, an increase of 11.5% year-on-year. UTI International, which represents our international business interest, has an AUM of rupees 24,207 crores as of 30th September 2023. Our international clients are across more than 35 countries, and these are primarily institutions, pensions, insurance, banks, and asset managers. One of our flagship funds, the India Dynamic Equity Fund, IDEF, domiciled in Ireland, has an AUM of $961 million. UTI International J. Saprasarasan Responsible India Fund, an ESG Compliant India Fund, has an AUM of rupees 78.4 million. UTI Innovation Fund, which was launched last year, has an AUM of 25.6 million. UTI Alternatives, coming to UTI Alternatives Private Limited, it has an AUM of rupees 1,799 crores and has a well-defined ESG policy and strategy. It currently manages the following active debt fund. UTI Structured Debt Opportunities Fund, HDOC1, launched in August 2017 and closed in May 2019. It has an AUM of 132 crores. Currently, the fund is in exit mode and has returned 1.1 times the capital invested. UTI HDOC2, launched in September 2020, has an AUM of 507 crores and the fund is currently in investing stage. UTI Multi-Opportunities Fund 1, launched in March 2022, has an AUM of rupees 763 crores and currently the fund is in investing stage. UTI HDOC 3, launched in September 22, has an AUM of 398 crores and the fund is currently in fundraising as well as investing stage. UTI Real Estate Opportunities Fund 1 is currently in fundraising stage and with a pre-commitment of 110 crores and net commitment of 30 crores. UTI Alternatives has also received the regulator's approval for two more funds, UTI Credit Opportunities Fund 1 and UTI Asset Reconstruction Opportunities Fund 1. We will be launching this fund soon. UTI Alternatives has the regulator's nod for providing co-investor portfolio management services. We have onboarded 7 clients as co-investors since September 30, 2023. I would now request the Managing Director and CEO for his concluding remarks. Sir.
Thank you, Sandeep, for sharing operational and financial highlights for the second quarter and half year of financial year 2023-24. I also would like to share with you that we have got a permission from SEBI to start our US operations. With this, I would like to open the forum for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Swarnabh Mukherjee from B&K Securities. Please go ahead.
Yeah, hi sir. Thank you for the opportunity. I have a couple of questions on the yield side. So first of all, the yield compression that we have seen in this quarter, just wanted to understand, is it only a factor of the mix change that coming from the ETFs, or within the equity category also there has been some compression as fund sizes increased? If you could call out also the yields for individual product categories, that would be very helpful. So that is one on the mutual fund business, and as well as on the international business, if I try to calculate the yield, I see some softening on that front as well. So what has happened there and how to think about it? So that is on the yields. And on the cost side, there has been some increase on a sequential basis on the employee benefits expense in the mutual fund business. So if you could highlight the reason and how should we think about for the rest of the year? And also related to the US operations that you have mentioned, whether we should expect any kind of additional costs and what would be the quantum of that in this year and next year in our unit. Thank you. These are my questions.
So now I'll take the question on the yield part and the employee cost. Let me first give you the breakup on the yield part. On equity fund, the yield for the quarter 2 is around 72 basis points. On the hybrid fund, 84 basis points. ETF and index fund is 4 basis points. Cash and arbitrage around 8 basis points, and income fund 22 basis points. During the quarter, while the equity yields are more or less stabilized at around 72 and 73 basis points, we have seen some headwind as far as the other scheme categories are concerned. On the hybrid fund, since we launched an NFO, which is UTI Balance Advantage Fund, there we have seen some yield compression from 90 basis points to around 84 basis points, only because of the mobilization of the new fund is slightly at a higher cost, and the yield on the new NFO is close to around 30 to 35 basis points. Also, we have reduced the expense ratios and the management fees under the ETF categories of the fund from overall expense ratio from 7 to 4 basis points. Because of that, there have been some yield compression under the ETF category of the fund during this particular quarter. On the income fund,
witnessing both at the industry level as well as in UTI, the significant inflows are actually coming into a shorter duration product where the yields are generally lower. So we have mobilized a significant amount of inflows under the income category during this particular quarter, which have been toward the shorter duration of the product, on which the management fees are actually lower as compared to a longer duration product. Because of that, the yield on the income category has also fallen from 26 to around 22 basis points. Because of that, the overall yield compression is there of around 2 basis points. However, the equity fund yield remains stabilized at around 72 to 73 basis points. On the international business, I don't think there is any yield compressions. There have been some marginal decline in the overall AUM because of some redemption under the IDF categories of the fund. And because of that, you might see some reduction in the management fees. Coming to the second question on the employee cost, overall employee cost on the standalone basis has gone up by around 6 to 7 crore. There are 2 to 3 factors. First is the normal wage increase, which is in spite of reduction of the retirement benefits. The increase is around 2 to 3%. Plus, there has been a ESOP amortization cost, which has gone up as compared to the previous financial year of around 2 crore. And also, there has been an actuarial valuation increase of leave encashment. The one-time figure until the interest rate goes down, that impact is around 3 crore. On the US subsidiary, as of now, we don't have any approval from SEBI, but
we have the approval.
The operation hasn't started.
Yes.
But as and when, yes, we open the offices, we expect the overall cost actually to increase.
This year there will not be any cost because we will by the time we get a license, it will be in March of 2024. We may see some cost next year, right? So this year there will not be any cost.
Okay, sir. Understood.
Just other than the legal expenses to the extent of 1 crore rupees for the group.
Got it, sir. Just a couple of follow-ups. So, if you could highlight why the expense ratios on the ETF side was rationalized, and I mean, 4 basis points. I think generally what I understand is lower than where most of the industry expense. I mean, yield should be on the ETF side. So, some color on that would be very helpful.
So we have submitted a revised bid for the EPFO mandate, and there are competitors whose expense ratios are even lower than 4 basis points. But this is the revised bid that we submitted for EPFO. Because of that, the expense ratios and the management fees have actually come down.
But our yields are best in the industry. In EPFO, our yield is the best in the industry.
Right, sir. And since a new player has also come in the EPFO flow, what would be our share in the incremental flow going ahead? Any color on that, sir?
23.5%.
Okay, sir. Okay. All right. Thank you so much and all the best.
Thank you. We have the next question from the line of Mohit from BOB Capital. Please go ahead.
Right. Yeah. Thanks for the opportunity. So 3 questions. First is you said you opened 29 new offices. So what would be the impact on OPEX for that?
So OPEX for this particular financial year, we are seeing maybe an OPEX can increase around 60 to 70 lakhs, especially on the rental side. Employee cost, there won't be any increase because we'll be leveraging on our existing employee spend. But for this particular financial year, 60 to 70 lakhs will be an OPEX on the rental and other costs.
All right. And okay, so 60 to 70 lakh increase. Right. My second question is that we did see equity segment having net inflows, which is good. But if I look at equity market share, it declined by around 22 basis point QOQ and 75 basis point YOY. So any particular strategy to redeem the market share on the equity side?
So yes, we have seen some pressure on the equity side, and we are working towards it. As we had mentioned earlier also that some of the funds, because of the performance issues and because of the strategies that we had developed, we were following the growth strategies while the market was towards the value strategy. So that has been impacting. However, as we have mentioned earlier also, we are on the course correction, and if you see in other categories, the income categories, we have seen a good net inflow, and similarly in the hybrid category also we have seen inflow. So we believe that the strategies that we are employing will work and will help us to claw back the market share.
We are repositioning some of our equity schemes which are performing very well. So we have very detailed strategy in place, and that will help us to recapture our market share in the other category of equity scheme other than the flexi cap fund. So we are repositioning other equity scheme which is well performing, like hybrid equity scheme, focus equity fund, etc., etc.
All right. Now this is helpful. Lastly, if I look at the SIP gross sales, it declined this quarter, and if I look at the industry, it has increased. So what could be the reason for that?
Yeah, so what we have done is we provide the data only for live SIPs. And during that, what we mean is that SIPs which are live and not paused. So if there are any inflows which are not coming for the last 4 months, then we call it as a paused SIP and we don't show it in our numbers. This last 6 months and this quarter specifically, we have done a lot of exercise of review. So we saw whichever SIPs were paused. Even from earlier we were looking at only which were direct, but we have also seen which are the paused SIPs from distributors, and we have not shared those numbers. That is why there is a marginal decline in the numbers of SIPs for us.
Okay, fine. So you mean to say that had you been disclosed those numbers, that numbers would have looked a lot better?
Yes, it would have looked better. But since we don't want to show all SIPs, we only want to showcase our live SIPs, that number has come down.
All right, understood. Thanks and wish you all the best.
Thank you.
Thank you. The next question is from the line of Madhukar Ladha from Nuvama Wealth Management. Please go ahead.
Thank you for taking my question. Actually, frankly, most of my questions have been answered. Just on the wage increase, what would be our guidance for the year? Because, frankly, we would have expected some sort of moderation, but still on a QOQ basis, salary costs are up by 5%. So, we expected some sort of operating leverage to play out over here.
Overall number, I don't see, Madhukar, increasing by more than 4 to 5% as compared to the previous year. We have some slight higher employee cost on the international business front, where opening of Paris CFCs and US operation also, there could be some additional increase in salary expenses. On the standalone number of UTI AMC, the salary increase will not be more than 2 to 3%. At a consolidated level, it could be max 4 to 5% increase.
Right, got it. And the other thing, while you explained the yield decline not being that related to sort of equity, but also, we are seeing like net outflows from equity. Isn't that hurting our back book, and wouldn't that have also sort of resulted in lower equity yields, equity and hybrid yields?
I think equity yields are more or less flat at around 72 to 73 basis points. But yes, if the stock AUM redeemed and is being replenished by a fresh inflow, definitely it's going to impact the yield. So that has been the trend in the earlier quarter, fortunately not in this particular quarter. But yes, going forward, if these kind of scenarios happen, if the stock AUM replenish at a faster rate, yes, yield compression might be there.
And final thing, sir, any sort of sense of what is our stock AUM right now in equity and hybrid?
Very difficult to give any exact number, Madhukar. because within the stock AUM itself, there are many banks and the distributors who for the last 7 to 8 years have been working on a trail commission. So it's not actually a correct number to provide that.
Okay. Thank you and all the best.
Thank you. Ladies and gentlemen, to ask a question, you may please press star and 1. We have the next question from the line of Lalit Dev from Equirus Securities. Please go ahead.
Hi, sir. Good evening. So thanks for taking the question. So I have a couple of questions. So first one was on our investment book. So in this quarter's investment book, if you see, there's a change, there's a shift of investments from mutual fund to G-Secs and bonds. So any particular reason for the same? And and also we see that there's a dip in the equity MF investment book. So what could be the reasons for this?
No, that more maybe we have got a better yield in some of the bonds and the G-Sec securities. Otherwise, if you see the normal allocations, around 60% of our book is into a mutual fund unit. And yes, the allocation to bonds and G-Sec has slightly increased. But no specific reason. Only the incremental allocation has gone to bonds and G-Sec funds.
Sure, sir. Okay. And so, sir, second one was on the net outflows in the core equity schemes. So, this was the second quarter where we have experienced net outflows. So, just to understand this better, in which of the channels we are experiencing the more pain in the outflows? Because, for the industry, this quarter has been a good quarter on the equity net sales.
So, the outflows have been across. It's not specific to any channel, but if we have to pinpoint a channel, maybe banking where there is a higher churn. But otherwise, it's been across. And as Mr. Rahman mentioned, that we are now positioning our flanking products there. And those products will be able to get back our share in equity.
Awesome. And so, could you also give us the gross equity sales which you have done during the quarter?
Gross, you are asking for this particular quarter?
Yes, sir. Yes.
Close to around 2,000 crores.
Sure, sir. Okay, thank you. Back to you.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. So firstly, if I look at your market share, it's been falling across. It's been weak across segments, not just equity, even hybrid. In spite of the product launch that we had, we just have a flattish market share sequentially. On income funds, we have an improved market share, but the major categories still seem to have, on the cash and arbitrage also, we have a decline. So what is the strategy that we would do to improve the market share? One, I think you mentioned on the equity side, but on the overall strategy, what would be the steps that you would be taking?
See, the market share is because of the two reasons. One, I will tell you the appreciation. Since the equity market gone up significantly, and as a result of which the various fund houses, which is a high equity AUM, the market, they got advantage of the improvement in the market share. Our strategy is to, but however, in the fixed income, we have done better, far better. We are in a position to now, we have launched the Balance Advantage Fund. So we will be in a position to address the loss of market share in the hybrid. In the equity fund, there are 5 or 6 schemes which we are working, and we are repositioning in the market, and that will help us to regain our market share in equity. And they are hybrid equity scheme, equity savings scheme, core equity scheme. They are well-performing funds, including arbitrage. The arbitrage generally, the arbitrage is not a very light for. And the multi-asset fund, these are the few funds which we are repositioning, and hopefully we will be in a position to recapture our market share. So, equity share. Vinay?
So just to add, I think hybrid and income category of fund, both on the quarterly average as well as closing average, we have actually increased our market share. Yes, under the cash and arbitrage, it's a seasonal kind of a product. In some quarters, you increase market share, in some quarters. But we are quite optimistic considering the kind of performance that we have, especially on the fixed income side. The market share should actually improve in next few quarters.
Any measures on the distribution side where you plan to increase commissions or something?
No. I think commission, the payout structure is more or less standard. There is no thought process of increasing payout to increase any market share. That's not the case.
Just extending that point, the yield on the balanced advantage fund that was launched was much lower, and we've been hearing from your competitors that the environment in the NFO market has been better than what we had seen in the last couple of years, but still our yields were much lower on that. So is that a challenge to get new funds, and that's the reason you had to bring in at that rate? Or what was the thought behind keeping it at such a low rate?
Even normally, if you see historically also, the yields on the new NFO is lower as compared to yields on the fresh ongoing scheme sales under the equity and the hybrid category. That has been the trend in the industry for the last few years, and we don't see any reversal of that particular trend.
Okay. Got that. And last question was, so you have your seed investments in the international fund. What is the quantum of that? And you had earlier highlighted about reducing that. So where how would that kind of where we are in that, and how should we think about it?
Yeah, we have plans to reduce it, but this 6 months we have not reduced it. So we have plans. We are waiting for the opportune moment with the sales increasing in IDEF, which is a flagship scheme, as you all know, IDEF, and we are constantly expanding our footprint. So we are now going deeper into the Europe, but we are expanding not only Europe, we are also expanding our reach in the Asia as well as Australia. So once we improve upon the overall AUM, then we will think of further reducing the stake in the seed capital.
What is the current stake?
Yeah, current it is around 18,000 million. $18 million. 18,000.
How much?
$18,000 million.
So $18 billion.
Yeah. How much seed capital you have? $18 million.
$18 million. Okay.
Out of group.
Okay. Thank you so much.
Yeah.
Thank you. Participants, if you wish to ask a question, you may press star and 1. The next question is from the line of Abhijit Sakhare from Kotak Securities. Please go ahead.
Hi, good evening. Sorry, I missed the numbers on equity yields. So if you could just reiterate the numbers in terms of the stock and the flow.
Flow, there is no disclosure as such. The stock AUM yield on the equity is close to around 72-73 basis points.
72-73 basis points. And would you have the numbers, let's say, a year back on the similar basis?
Years back, it could be roughly in the range of 80 basis points, yeah.
Okay, all right, got it. And second one is that the 4 to 5% expense growth guidance, is that on an overall basis or only on the staff cost?
On an overall basis.
All right, got it. Thanks a lot. Done.
Thank you. We have the next question from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, good evening, sir. Just a few questions. First, on the international business. I mean, all of the expenses that you needed to incur for the French, for Paris and the US facility, have they been incurred, or can we see some lump sum expenses coming in the second half?
Yeah, some legal expenses, as Mr. Rahman told, will come in the second half. But any major expenses, including the hiring of the employees and other establishment costs, that may come in the first quarter of the next financial year.
Got it. Second, on your standalone business, in the last 2 or 3 quarters, you have kind of increased your employee base quite significantly, even in a situation where probably AUM growth has been relatively, at least on the flow side, has been relatively weak. So just wanted to get some sense of where you are really adding these employees and, are you strengthening your sales distribution or, or where are you really adding them in a way?
So mostly will be are in the distribution space. As you are aware, we opened 29 new USCs. We also are planning to open roughly around 8 to 10 resident offices across the length and breadth of the country. So any employee increase will be mostly to our sales and distribution side.
And we are also planning to go for the direct, and therefore, and there are a lot of sales team senior people are retiring. In order to keep the bench ready, we have appointed additional management trainees from the campus.
Got it. 2 more questions. One, on your product pipeline for the second half of the next, let's say 6 to 9 months on the equity or hybrid side.
Yeah, so we have approval from SEBI for 3 funds as of now. One is UTI Nifty IT ETF, one is UTI Nifty 10 years benchmark GSET ETF, and one is UTI Nifty 5 years benchmark GSET ETF. So as and when there is an opportune time to launch this fund, we will be launching these funds.
So just if I got it correct, there is no active equity sort of funds or sectoral funds that you are planning to launch in the next?
No, mostly all are on the passive side, passive ETF.
Last question, in some of your schemes where you have seen weakness in performance, or at least, fund performance, at least now, maybe the 1-year category has worsened a bit and maybe gradually gets reflected in the 3 or 5 year bucket. Are you taking any steps out there? And if so, can you just elaborate on that?
And I don't think I should be in a position to give any color on it. Our fund management team is true to its philosophy, and they are fully committed. We are very competent team led by Mr. Vetri Subramaniam and Ajay Tyagi. They continuously review their portfolios, but I don't have any idea to give you any color about this one. These are led by our fund management team, and they have the complete authority and autonomy to decide. And we do every bit in the best interest of the investor. But we are true to our philosophy, both for the growth and the value opportunity philosophy.
Got it. Thank you, sir, and all the best.
Thank you.
Thank you. Participants, if you wish to ask questions, you may please press star and 1 at this time. The next question is from the line of Gaurav Jani from Prabhudas Lilladher. Please go ahead.
Thank you, sir. A question for Vinay, sir. Sorry, sir, I missed a comment from the yields. So I believe equity yields were 72 bits on stock basis for the quarter. What would they have been in the last quarter?
It was similar. In the equity yields are almost flat at 72 to 73 basis points. There have been marginal decline in the yields under the hybrid category, where, as I stated earlier, because of this NFO, the yields have actually dropped down.
Okay, and sir, that you would have seen some decline in yields?
Yeah. That also, as I stated earlier, in the debt scheme, the significant inflows are coming into a shorter duration product where the yields are lower. Because of that also, there has been a 4 basis point decline on the fixed income yield on a quarter-on-quarter basis.
Understood. And ETF would have been about 1 or 2 basis points.
Yeah, almost around 3 basis points on the ETF. As I stated earlier, that was because of the revised expense ratio that we submitted to EPFO.
So the 3 basis decline would be on the stock?
Yeah, it's on the stock as well as on the fresh inflow.
Understood. So, second question on the tax rate. So this quarter again we saw lower tax rate. So one of the reasons for that, and secondly, drawing parallel to the last year,
generally after a couple of quarters of low tax rate, we see a bump up in the tax rate. So should we see similar sort of numbers in the second half, or how should we look at the overall tax rate for the year?
I think overall tax rate should be in the range of around 20 to 20.
Yeah, we don't go by the effective tax rates of any particular quarter. For the overall annual, the effective tax rate will be in the range of 20 to 21, as Vinay is telling. Because quarter-wise, you don't get into that because it depends on a lot of investment income and our deferred tax reason. So annually, the effective rate will be in the range of 20 to 21.
Understood, sir. Thank you so much, sir. That is it for now.
Thank you. Ladies and gentlemen, to ask a question, you may please press star and 1. The next question is from the line of Bhuvnesh Garg from Investec Capital. Please go ahead.
Yeah. Thank you for the opportunity, sir. So just want to understand the structure of our trail commission for NFLs, recently launched NFOs. Whether it is a fixed percentage throughout the tenure of the fund, or is it a step-down structure? For example, higher commission in earlier 1-2 years, and then later commission, lower commission later on. And how this structure has changed in last 2-3 years? Just your thoughts on that.
Yeah, normally the first year payout is slightly higher, and second and third year onward the trail commission gets reduced. So that has been the trend over the last 2 to 3 years.
Okay. And sir, is there any particular limit as such that how much higher commission you can pay in the first year and how much lowest commission you can pay in the subsequent years? Is there any limit on that?
No, there is no limit. Means SEBI doesn't allow the commission cannot exceed the distributable expense ratio. And when I say distributable expense ratio, is the scheme expense ratio minus the operating cost. That's the limit being defined at the SEBI guidelines.
Got it, sir. Got it. Thank you. That's it for me.
Thank you. The next question is from the line of Sunil Shah from SRE PMS. Please go ahead.
Thank you, sir. Thanks for the opportunity. Sir, my question, in fact, sorry I joined in late, but my question is more from the industry perspective. Sir, the way in which regulator is addressing the expense ratio, and so the industry's volume will certainly go up over a period of time. But in between, meaning for the near term, will we see pressure for most of the AMC companies because of this regulatory thing, which is there? Second being competition will increase and technology also plays a big role. So all those factors will result in, the NAV charge that we actually take from the customers. Will that number see a shrinkage overall from an industry perspective? It is not company specific, but overall for the industry. Could you help me understand that? That is one part. And second is more and more passive funds are being launched rather than active ones. There also the charge to the customer would be at a lower rate versus the direct active fund management. So would those things be right in my assumption that overall the income for the industry overall could see some kind of correction before the volume really come in over the long term and then the market really explodes? That's the second situation. But could you help me understand this better? Is my thought on the right direction?
I think industry thought process, I can say is very, very clear. If any TER reduction comes, that will be passed on to the intermediary. So AMC margin, I think most of the AMC will try to protect the margin, and the TER cut will be passed on to the intermediary on a long term. And yes, there will be some pressure as far as the margin is concerned, but we believe that the volume growth itself will compensate with the overall revenue growth. So margin may contract a little bit because of the reduction in the TER, but overall the AMC margin should get protected, and the volume will actually play a much important role going forward. And as you rightly said, with the growth of the ETF and the passive fund, the overall number of the management fees is actually coming down. So volume is one where we need to look at it, and the overall revenue number we believe should be improving on a year-on-year basis, and obviously operating leverage play in its part. Since the costs are not going to increase substantially, the PAT margin should improve from here onward.
And it is important to see this is a business opportunity. The industry is growing with a greater speed, and therefore regulation is there to help the investor. Regulation is not there to harm the investor. So we should not see from the regulation perspective, we should the opportunity perspective. And I believe there is tremendous opportunity for the entire industry to grow.
Sure.
And as Vinay has rightly pointed out, the OPEX, so far as the passive is concerned, is not going to increase. It's only the volume is going to increase, and therefore the absolute yield will be far superior for the entire industry. We are quite confident.
Sure. So if I can dwell upon one more point, so given the rate at which the country itself is growing and a lot of things which are very positive, which are happening right now at India per se versus the world. So can we try to look at, global investors looking at AMC as a platform through which they can take Indian exposure? Can we work towards getting money from the international market? Because getting money in India is perhaps, I'm sorry to use this word, has become a commodity, wherein one AMC differentiates from something and the other AMC tries to replicate it overnight. But if we try to get money from the international market and have some presence there, is there any thought that we have within the organization on such a point?
Yeah, no. I don't feel these are always all commoditized products. So we will not be in a position to give you any color about that. India is a great destination, right? India is the only country which is now talked globally, and in every conference room, India is spoken about and discussed. I was there in London 4 weeks back, and I see the huge amount of optimism about India. So whether the product is commoditized, all about, but the performance, differentiation will be bring from the performance of the fund house and the fund manager, and that's how we will be in a position to differentiate. But India will continue to be a destination despite the fact that the products are commoditized.
And we are focusing on in the international business, and the testimony to the fact is we have opened an office in Paris, and we are also opening an office in USA. So yeah, the international business focus is very much there, and we expect volume growth from that business as well.
Fine. Thank you, sir, and all the very best. Thank you.
Thank you. The next question is from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, sir. Thanks for giving me the opportunity. Just two small questions. One, could you just repeat your point on the ETF yields and why they declined during the quarter? And second, from a fundamental perspective, when there is, let's say, a slab change in your equity AUM, I would presume that the gross expense ratio gets reset immediately. But do you have any flexibility on the payouts on the back book, or is it like it's just a pass through to your net TRs, which also declined by almost a similar magnitude? Just talking of the back book.
So I couldn't get your second question, but let me answer for the first question. The ETF yield drop has been because we have submitted a revised proposal to EPFO, and because of that, the expense ratios and the management fees have actually come down by around 2 to 3 basis points. And they got effective from 29th of June.
Once again, the EPFO came out with a revised RFP, and 4 of us were selected: SBI, UTI, ICICI, and Nippon. And everybody put this revised score. Amongst all of them, we are getting a allocation of almost 23.5%. But amongst 4, our fee is the highest amongst all 4. This you please take note of this one. Vinay, over to you.
Could you repeat your second question, please?
Yeah. So before that, just to follow up to this question, can you quantify your EPFO AUM within your ETF space, if that's possible?
We can't share with you those data, right?
Okay, sure. On the second question, sir, let's say when your AUM grows on the equity side or even on the hybrid side, and you see a change in slab for the TER structure, I would assume that your gross TER resets immediately. But do you have any flexibility on the distributor payout on the back book, or do they continue to remain at whatever levels they are?
Yeah, normally we don't. You are telling on the stock AUM?
On the stock, yeah.
No, on the stock AUM, the commission structure remain as it is, and maybe in due course of time we will correct that. But on the fresh inflows, the commission structure gets adjusted immediately.
Got it. Thank you, and again, all the best.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Mr. Imtiyazur Rahman for his closing comments. Over to you, sir.
Thank you, and thank you. I would like to our sincere thanks. I would like to express our sincere thanks to all of you for your participation. Thank you and good night. Have a nice weekend whenever it comes to.
Thank you.
Thank you. Ladies and gentlemen, thank you for joining the call. In case of any queries, feel free to connect with Adfactors Investor Relations team. You may now disconnect your lines.